year. We had Carl Rule last week, but Jorge, let's kick off with you this morning. Jorge, of course, president and founder of Global Markets. Jorge, we saw oil close last week above $87, above the high of 2021. What does that tell you, and what's your outlook for this oil price now that had a bit of a run up since we crashed in late November?
Okay, what those high prices tell me is that central banks globally are going to be essentially very concerned and focused on what they do on their interest rate policy. As oil prices rise, which we have been expecting, the specter of inflation raises ahead globally. The run-up we have had globally, not just in oil, but in just about any commodity you can think of, and focus on gas and power, is caused by monetary creation. And number two, very importantly, is the recovery we have seen globally in commodity consumption. Those two things are essentially still in place. The world financially and continues to grow in terms of the central bank policy. What they have is worries, what to do about it, about that pace of monetary inflation. And number two, COVID is really disappearing insofar as we know in places in the West where the population is not COVID naive, but essentially reaching herd immunity. So if you put these two things together, there is a incredible force to the upside on prices. And barring central bank intervention, prices should continue not in a straight line up, but continue to drift upwards and upwards as we go ahead, crossing the triple digit fairly soon. I was expecting that to be this month. Of course, that did not happen. But please note how the price of very key commodities like dated Brent rose above $90. And this is at a time that equity markets have collapsed, essentially, in the US. I think that's one of the big things for this week to come, is how do people feel about the equity market? Because if there is a substantial further retreat in equity markets, of course, commodities get affected. And
let's bring in Christoph Rule on that. Christoph Rule, Senior Research Scholar, Center on Global Energy Policy, Columbia University, of course, the anchor of the Sunday Week in Review show. Christoph, your thoughts, just picking up on that last point that we did see last week. It seemed finally the equity markets wake up to the fact that the Fed is going to increase rates by whatever number of times. And we saw the biggest reversal in the equity markets for over a year, with the NASDAQ off 7%. S&P similar high single digits. Your thought of whether we're going to see a diversion between equities and energy. Equities will correct, but energy will not. Your thoughts?
So, good morning, first of all. Maybe it's a good idea to start with equity markets, because these oil market explanations and energy prices being caused by monetary inflation, whatever that is too convoluted for me. Normally, high energy prices are a consequence. Are a cause of inflation, not a consequence. So everything else requires some separate explanation. But let's start with the Fed, the interest rates and equity markets, systematically what you were asking. There is a key number which I think sums up the surprise of equity markets quite well, which I just stumbled across by accident. When we go back to December 2020, December last year, and look at the Fed's forecast of the inflation rate for 2021, what was it? In 15th of December 2020, the Fed projected officially inflation for 2021 at 1.2%. And now a week ago or so, we had the number coming in 7.2. This may be adjusted a little bit, maybe averaged, but we will end up with an inflation rate of 7%. So it can happen to the best of us, and it does, of course, but that's a gross misprojection. And consequently, the pivot which the Fed had to do when it realized that it was dead wrong in inflation, and those, including on your Sunday program, who had argued that inflation will come, were right, including also those in the US like Larry Summers. The pivot it had to do was therefore quite dramatic. and came unexpected to markets. And the markets, I think, still lived a little bit with the hope it will not be that bad, and it will just be, from 0.25, sorry, interest rate going up to 1% or so. But if inflation is persistent and is here to stay, we will see two things. We will see a need for more rate raises, maybe more over time, and we will see more disappointment in the markets, even if the consensus among policymakers will be that an inflation rate of 3 or 4 is not too bad, given the indebtedness of the situation. So that's the part of equity markets that caused equity markets to be surprised. The Nasdaq is now officially, there's no collapse, but the Nasdaq is officially now in correction territory, and I would expect the volatility in markets to continue as they
correction territory being over 10%.
20%. I think 20 is the
20. I'm not sure we're quite at 20 yet from the high, but certainly over 10.
Yeah, we have to look at them. But I would expect it to continue to gyrate between sort of recovery, which then is called a investment shift, which is true also into value stocks away from growth stocks, and then the necessary victims it takes as growth stocks are being sold among the rest of the market. So it creeps in from the most risky parts of the market into the rest of the market, and will end up, no doubt, in a substantial correction.
Jorge, just on that point you made, I mean, to be bullish on the oil and the reasons why there is a tight market, a strong market for oil, and at the same token, a weakening equity market, and the potential in that weakening equity market, the story that it tells us is that the Fed has lost control and might drive the whole bus off the cliff, i.e. drive us all into a recession if they have to really slam on the brakes. What's your projection on that intersection point that the Fed and others have to overreach quickly?
Well, if we keep it again to the high level, oil prices from the beginning of the year to now have increased over 12%. And equity markets have fallen about 7%. So that's a disjointment of about 20%. The central banks, but primarily the US, has a big responsibility in the rate policy and what they're going to do immediately, while inflation is at 7%, as Christoph has indicated, and most likely over that, depending how you measure it. But if they over-tighten, the whole thing comes collapsing like a house of cards. And they know that. And the US administration, Biden's administration, will face an election for the midterms in less than a year. Therefore, there's all political pressure to do something to take care of inflation, but not to overdo it. Because otherwise this plays out, and in the American psyche, a collapse in the equity market is worse, much, much worse than a rise in the oil prices. So my expectation is that central banks are going to
is it worse? Is it worse than inflation, Jorge? Equity crash is worse than inflation.
I don't think for the world as a whole. For the world as a whole, inflation is much, much worse. But for the American psyche, a collapse in the equity market is much worse. Everybody still remembers what has happened in the past, all those falls we have had, very severe, 2008, 2000. Nobody likes that, right? Everybody has a 401k. It's very different from the rest of the world. The American population as a whole, on average, has money in the equity market. The world as a whole does not. And they suffer directly inflation. So if you put all of this together in a box, I would tend to think that the Federal Reserve is going to be restrained in its actions.
So they're talking the talk, but not going to walk the walk. Christoph, you wanted to jump in? Sorry.
Yeah, I have to. Okay, but on the Fed, first of all, there is a well-known bias over the last 10 years or so that they are very quick to react when it comes to sustain low interest rates, to sustain support to the economy and to financial markets. And that they're systematically very slow. Remember, the Greenspan put ever since then very slow to react when it comes to raising rates and to exposing the equity market to any kind of danger. And that's, of course, not just because many Americans have a pension fund in equities, which is true. That's mostly because those people who have a say, those people who sit on webinars like us or on TV, the talking heads or the politicians, or so the upper echelons of the wealth distribution, they will have a lot to lose, just as they gained a lot from rising and falling equity markets. And in America, more than in the rest of the Western democracies, I would argue, it's that sort of elitist group which caused the shot. But secondly, I mean, I have to say something on this nexus between equity markets and oil prices. That is just, excuse me, something I don't understand, because of course, economic growth and economic demand is the key driver of oil prices. And therefore, you often see a coincidence of economic growth, some part of the world, driving up with a lag oil prices. And we had since 2000 until the crash 2008, driven by China and the non-OECD, as you had later in the recovery after COVID to some extent. But the oil market is not driving equity markets. And the oil market, in our particular case, the oil price has gone up so smoothly and so fast because of a political decision of OPEC Plus to cut supplies, full stop. There is no sort of secret mixture here between the Fed and interest rates, and there is no reason to expect equity markets and oil markets to move in tandem at all times. Over the long term with a lag maybe, but only in demand market-led phases, demand-driven market-led phases. In OPEC-led phases, as we have seen right now, it's a shortage of supply, politically motivated, and they may or may not react to the economic situation. If global growth turns down, we would expect them to go a bit softer. The key question in oil markets remains the same. Is when is OPEC running up against its normal capacity of 2 million? That should happen this year. That would indicate tensions. And when and to what an extent is supply coming online from outside OPEC Plus? So those are the oil market drivers.
Just to wrap up on that particular session, I don't know if you can see this graph. I just picked it up from the FT today, which is the Berkshire Hathaway fund at the bottom, the sober blue line climbing, and then the pink one is the ARK Innovation Fund, the sort of the poster child of the last 18 months of boom. They've now arrived at the same place, which I thought was quite interesting as to where we are at the moment. Innovation.
It's a great place.
Has
there's
come
another
to,
good, there's another good, I forgot what it was called. There's another good read in your package about the super cycles. Now, this is the third or the fourth one, and how they always come back to trend. And that the only question is when this will happen this time. Very nicely written.
The other big story last week, Jorge, was geopolitics, and most notably Ukraine and the issues of that. They seem to be boiling in the wrong direction, more negative than optimistic outcomes there would seem, with the British government overnight actually identifying who they expect to be the puppet president of Ukraine. Your thoughts, Jorge, looking back on the week that was, where we go with this big geopolitical fracture?
Yeah, well, in the way I see the world, I have observed big governments to create a ring of protection around them, whether it's seas or client states. And therefore, using that approach, one would think that Russia feels very strongly about the Ukraine remaining in its side. And there are various interpretations. Biden has said that Russia may act. Then there was a clarification about that. I hope there is no military action because, again, the house of cards would come collapsing, whether it's equities, but it would be very positive for oil. But nobody wants oil to go up because the rest of the world is falling.
The world blowing up.
Exactly. And it's interesting also to observe what happened to the Navy chief in Germany, who had to resign. All he was saying is that Russia needs some respect and essentially to give them that room of protection around and for the rest of the world not to meddle too much in those former states. Of course, he lost that battle. He had to resign. And I think the world is becoming, in so many areas, increasingly polarized. Let's look a little bit further in time. If something is going to happen militarily from Russia to the Ukraine, the window of opportunity is at most 5 weeks long, maybe 6 weeks long, because the war equipment cannot move after the earth is no longer frozen. That area of the world has that particularity that you can get mired in mud. So if anything has to happen, it has to be in the height of the winter, when temperatures are extremely low. Everything I have seen is a lot of posturing, but I don't see anybody shooting anything. But we need to be very alert over that window of time, which is on the long 6 weeks, but it's shorter than that. And here, where I express, I hope nothing happens. And Russia has been very clear in what it wants. What Russia is saying is, I want my ring of protection. Don't meddle with that. And I don't know if the West is listening, but I hear a lot of drums. That is very positive for the price of oil and the price of gas and the price of power, and extremely bad for Europe.
Christoph, your thoughts, and particularly on that role of Germany, or obviously your home country. We have an SDP chancellor for the first time since Gerhard Schroeder, who's currently the chairman of Rosneft and the chairman of the Nord Stream 2. Clearly, there's a close relationship between the SDP and Russia. The timing of this indicates a fracture, a weakness in the European West position that, of course, Putin can expose. Your thoughts on this story?
You have to really start at the other end, at the Russian end, to make sense of it. But let me add a footnote to what you were asking, what Jorge was saying. It is incorrect to say that this German admiral was fired because he said Putin wants, all Putin wants is respect.
So he's removed, correct, you mean, removed?
Well, he resigned, but it's correct that this was happened because he said the Crimea will not go back to Russia. Putin does not only want respect, but deserve respect. So he took political positions which are diametrically opposed to what NATO officials' position is on the Crimea and what therefore Germany's official position is. So he was becoming completely untenable. He would have been fired, not allowed to resign by himself in most countries. On the conflict itself, if you ask me about the problems coming up, number one would be Ukraine, number two would be Ukraine, and number three would be Ukraine. I've lived in Russia long enough, and I have still friends there I'm working with. And I think that what we have is an almost intractable situation, which is very likely to lead to a military escalation. Probably not in the form of a full-scale invasion of Ukraine, because the occupation and the costs of that would be too costly. But certainly in the sense of taking the Donbass and the Lugansk region and then either having them as autonomous regions, as Russia did with these regions around Georgia quite a few years ago, or incorporating them into Russia flat out. And the context for that is not some legitimate desire to have a cordon blanche of security around Russia. The context of that is Russia doing all the saber rattling, amassing 106,000 ready-made troops around the borders. And that's not the kind of normal behavior in 21st century diplomacy, which we see here. What we see is, what we have to understand, and it's very important and hard for us to understand, is that Russia does not want a thriving and prosperous Ukrainian democracy at its eastern border, which could be attractive enough to attract the attention of other countries in that region. What Russia wants is a crude mix of nationalism, going back to the origins of Slavs being there in that area, is the desire for revanchism for those who decided to go their own way after the Soviet Union collapsed. And what Russia wants in its orbit is a subservient state with a non-functioning government, which acts as a buffer in that sense, but not as a buffer of strength to defend something noble, but just, it's driven by the fear of the thief to be attacked or to be caught. And it reminded me I'll tell you a little story, then I shut up. So almost 20 years ago, in 2003, I think, Khodorkovsky, the head of the richest man in Russia at that time and the head of the biggest Russian oil company, all of a sudden was arrested. And the rest of the world sort of sat back with awe and said, how is that possible? And at that time, and that was the same government, the government of the same president in Russia as we have today. At that time, I asked a friend of mine who was an old and very wise sort of economics professor, but still very wise in Russia, in Moscow at the university. So what's going to happen next? And he sort of looked at me and smiled and he said, well, now the wolf was hungry. Now the wolf has eaten. Now the wolf will rest, and when it wakes up, it will eat again. It will be hungry again. And this is the kind of pattern which we have observed. And I'm afraid with all the weakness in the Western response and with what is true, the parts of the German establishment trying to prefer peace at all costs and preserving gas deliveries and all of that, and the enormous Russian leverage it has with the West, that this is the situation which we will find ourselves after the Ukrainian crisis has been settled, after the wolf had his little dinner. We will settle down, and then it will happen again a few years down the road. I think this is a much more consequential crisis than most of us are aware of.
Jorge, coming back to the sort of immediate realities of fundamental supply and demand around the oil markets, we're seeing tightness. Obviously, the global oil inventories are well below the 5-year average now, and declining. We're seeing the rig count in the US going up and shale increase. Where do you see the fundamentals at the moment and the outlook supporting this price, and as you said in your earlier comment, possibly continuing to elevate upwards?
Yeah, the big thing happening facing us is not the increase in shale rigs, because they take time to generate the production, and I hope they do, and they will. But the most immediate change is our behavior as COVID fades away. If you see what has happened over the last 3 days, and there are some countries I monitor very closely, China continues to tighten, and it reduced the amount of flights coming in from the US, and the US reduced the amount of flights going from the US to China. So China is a fortress, trying to have a policy of zero COVID. I think is very mistaken and wrong, and it will bite them. But the rest of the world is moving forward.
Just on that point, Jorge, if I might ask you, what or do you identify as the consequence of this fortress China COVID policy? Is there a notable consequence yet for the global economy, for the oil markets?
Yes, of course. One of them is inflation, or a rise in the prices of several commodities and products that China makes, because it's a cranky process to ship them out. Ships have to wait a long time to discharge. Crews have to wait a long time to enter China and load things. It is really messing up the world in terms of supplies, but it is affecting them. The question we all have is, how long can the Chinese people take it before the political pressure starts to mount internally to open up? I was in Singapore very recently, and people told me that there would be most likely a change in the Chinese policy by June. And we already see that very strong change in countries that have been leaders in how to handle COVID, and I would put the UK. In the UK, for all practical purposes, we have been kind of normal for 6 months. And in the UK, right now, anybody can fly in and fly out. And the amount of red tape that we need to face is very, very minimal. Countries like Singapore, who are former colonies of the UK and are still, even though that was a long, long time ago, still have an empathy with the UK and follow them very closely. And for all practical purposes, Singapore policies regarding travel are the UK plus 2 or 3 months. And yesterday, they announced further opening in that situation. It will be a lot easier to come in, the amount of tests that you need to take. So those are leaders in how it's changing. And Europe is considering right now to approve a recommendation of making travel extremely easy again. So the Northern Hemisphere and key parts of around the equator and south are moving forward into the right direction.
And ultimately, that is a demand recovery story that is significant for 22.
Huge. The surge we will see in the number of flights in the hospitality sector is that if you're a little fearful about the equity market, maybe you should put some money into airlines and hotels, because they will benefit no matter what is happening. Money.
There's always a winner and a loser. Let's get the survey question and bring in Christoph on this point. The survey question is sort of reverting back to our first point of the discussion this morning. Global equities suffered their biggest declines last week in more than a year as heavy losses in tech stocks spilled over to other sectors. The question is, will oil follow equities or diverge? We've had pretty much a year or more of everything, all boats rising ultimately. Now we have a boat that appears to be sinking equities, certainly in moving towards correction territory, maybe bear market territory, which is 20%, but now above 10 decline. Will oil follow equities or diverge? That's the question for this room this morning. Your thoughts, Christoph, on that last question, the last point, the sort of fundamentals of this market at this time. We're on a year in which the China outlook seems a little bit softer. The global growth by World Bank and others seems a bit softer, but yet there is a tightness. Your outlook of the fundamentals at the moment and the week ahead, obviously.
So let me reiterate, there is no, the question is, I'm sorry to say, it's just not really adequate. There is no automatic link between equities and oil markets.
Well, I turn to have to disagree with you and say that the link is that equities are being impacted by a central bank policy that has lost control of inflation and is now, over 3 months ago, was talking about no interest rates in 22, was talking about a 6-month taper, is now on a 3-month taper and talking about 4 rate rises in 22, which ultimately, if you lose control of managing inflation, you drive the economy into recession, and recessions are lower growth and bad for oil demand.
Exactly. So that's exactly the point. But John, look, this is called long and variable lags, right? For a purpose. This is not, a central bank making a misjudgment and the equity market collapsing and the economy turning around into a recession and then the oil market at the same time. This is, if you are in a very elevated point, the equity market suffering and collapsing, and then the economy slowing down in growth, and then the wealth effect kicking in, people spending less, and then oil demand being affected and neglecting all the supply issues on oil markets, probably moving in the same direction as the economy. That's what I said. The only link here is economic growth, and that comes with a long lag. So as of what happens tomorrow, which is what we mostly seem to be interested here, I'm afraid, there are factors pushing the oil market up and down, of which global demand is a key one, of which what Jorge has pointed out happens in China is a key one. It's not only making Chinese exports more expensive, making also oil demand and commodity demand from China lower, and therefore potentially oil less expensive. But there is no this kind of direct, immediate one-to-one smoking gun. If somebody would have found that, people would bet on it a long time ago. Now, on what will happen, again, I think the conclusion that the equity markets will immediately adjust is also probably premature, because there is some scope for a post-COVID recovery. Yes, there are some hints that things like travel industry, airlines, and so have further to go in the recovery. Brings me back to the Ukraine. Again, what is important here, potentially, by an order of magnitude more important than what we've been discussing, is the consequences not of a little war in the Ukraine, but of the sanctions it may trigger. If there are, what the US continues preaching, if there are really sort of what they call maximum sanctions, which would mean no Nord Stream 2 and cutting off Russia financial institution from the SWIFT system, I can't see this happening. But if that were to happen, then the energy markets would be in complete turmoil. It would be very hard for consumers of Russian oil to pay for it, for these exports. It would be very hard for the US and the Europeans to maintain a united front in the face of rising gas markets, and oil prices would certainly go through the roof for a period while the economy would, including the airline and the hospitality industry, would suffer. Right? It was a complete different reaction from what the premise of the question is. That is a risk, and that is because I think Biden knows that, of course. That's why he had this slip of a tongue, and he made this artificial distinction between a full-scale invasion and a little incursion, basically saying, we expect them to do something, but hopefully it will be just an incursion. And in an incursion, we won't have the full armament at our disposal because the allies will not be with us. Maximum sanctions is something only the US can afford to apply to Russia. They have enough oil themselves. They have a strong enough financial sector. Europe cannot do that, or could do that, but there's no appetite for Europe to expose its population to something like that. So that would lead us further down the path of a fractured global community, and it would drive up energy markets considerably and hit equity markets worldwide.
Let's just get the survey result, give Jorge the last word on diverge. So we're going to see a diverge, which would indicate perhaps prices in oil staying or rising. Jorge, just sort of closing out on some thoughts of this geopolitical story. You're a little bit more optimistic on the outcome, I think, than Christoph there. But also, where does it intersect with? We have a few things sort of coexisting at the moment. You have the Iran nuclear talks in Vienna. You've got this conflict in the Ukraine. Can OPEC Plus survive a Ukraine invasion or a Russian invasion into the Ukraine?
Yes, they can, and monetarily they would benefit enormously from it because there would be a huge pop in oil prices. But let's consider there for a minute. Are we saying that we're on the verge of a major world disaster militarily? Because this
the US president has said that he expects something to happen. So let's take the guy at his word. To what extent the British government has announced, even they've identified the new president of Ukraine. It does appear that, there's enough reasons there to think this is quite serious.
So if we accept that premise, let's focus on
the markets don't think so, I would say. I'll just sort of make that note.
If we accept the political premise of those statements, then of course go long oil and sell equities, because that spread is going to go in favor of oil. If you don't think that's going to happen, that the world is going to become peaceful, then go long equities and go long oil, because oil is going to benefit from no COVID, right? So no matter which way we look at it, oil is going to be positive relative to equities in this quarter. And let's take this number. Oil has gone up 12% since the beginning of the year, and equities have fallen, depending on the index you use, between 7 and 10%. So there has been close to a 20% recovery. If something happens in the Ukraine, that spread will widen further. If there is no war and COVID goes away, which seems to be going, that spread will widen further as well.
Well, let's wrap it up there. I mean, my 2 pennies worth on that point. I think it is worth at least paying attention to that OPEC Plus, i.e. Russia, Saudi, UAE alignment in controlling the global oil markets. I'm not sure if it could survive an invasion of Ukraine by Russia. In this sort of claim that the US would impose some very severe consequences, whether they be sanctions or otherwise, as Christoph highlighted, those sanctions piece could be some of the collateral damage. And OPEC Plus, I think Washington maybe start paying attention that this is a very powerful organization that perhaps they should not be supportive of. I think that's something to keep an eye on. Who knows? There's so many threads to this story, but that's just one of many. Jorge, wonderful to have you back. Happy New Year. Thank you so much. And
Christoph,
as always, thank you for anchoring the Sunday morning. Have a great week, everybody. We'll catch up with you every morning at 10:30 UAE time. All the best.